Today is the last session of this module. Last couple of weeks we were discussing about foreign exchange, and then we moved on to derivatives, and we discussed options. Any questions on options? We discussed the basic option features: call options, put options, European options, American options, the payoff diagrams. So any questions that you may have? No? Right. The price of an option, right, which we discussed last week, is called a premium. It's just like the insurance premium. So when you buy a vehicle, you get it insured, and it depends on the premium that you pay depends on so many factors. So likewise, the price of an option also depends on several factors: the price of the underlying, the strike price, time period, interest rates, volatility, right? Now, option price, right, or the premium changes in various ways when these factors change, right? That means they are sensitive to any changes of these factors. Now, for example, if interest rates change, when interest rates are high, the option price is high, and when interest rates are low, option price is low, right? So when interest rates change by 1%, by what percentage does the option premium change? That can also be measured using these. Right. First one is called delta. It means the change in the option premium for a given change in the underlying price. How sensitive is the option premium to changes in the underlying price? That is measured by delta. Then gamma measures the change in delta for a given change in the underlying price. Right. Then we have theta. What is the option premium sensitivity? How much does the option premium change when the time period changes? Rho. What is the change in option premium when interest rates change? Right. And vega. By how much does the option premium change when volatility changes? Right. Now these things nobody understands, so they are called option Greeks. Okay. Option Greeks, right? It's not because nobody understands, but this is what they're called, and not very complicated actually, right? So we are not going into great detail. What you should know is option Greeks, that there are something called option Greeks, and option premiums changes whenever these change, right? So if your customer wants to do an option and he does an option today and then he decides not to do it today, he does it next week, the price has changed, may have changed for these factors. Right? If everything else is the same and any of these change, then the option premium can also change, right? So they don't stay static. Okay. The other thing is, now these Greeks, especially delta, is very, very liquid. There is a market for these option Greeks. Most of the options, in fact, trade based on the Greeks. Right? You trade the Greeks. So there are specialized traders. Their job is to trade option Greeks. Okay, so it's a very, very vast market out there. Then option strategies. Right? This is all about putting one or two options together, or even more than that. Sorry, putting two or more options together to form a composite product. Now, for example, what happens when you add a call option and a put option? or what happens when you add a call, buy a call option and sell a call option, right? So likewise, you can combine these options in various ways, right? You can combine a call option with a put option, or you can combine two call options. You can buy two call options, sell one call option, and then you can do trading based on that, based on your view of the market, what is going to happen to markets, right? So basic option strategies involve buying buy a call or put option. Buy of a call option gets the protection from upside movement of prices, and the buy of the put option receives protection from the downside movement in prices. The cost to the buy is the premium, right? Now you're buying two options in this case, buying a call option as well as a put option. So whenever you buy an option, you have to pay the premium, right? And if the option doesn't get exercised, then you lose the premium. But the cost to the buy is the premium, loss is limited, and profit is unlimited. Okay, because the moment you buy an option, the maximum you will lose, whether it's a call option or a put option, is the premium. You will not lose anything more than that. But if you sell an option, if you sell a call option in particular, your losses can be unlimited. You're exposed to unlimited losses. A straddle, now this is the first product, right? It's called a straddle. That means you buy a call option as well as a put option at the same strike price. Your long call, long put, same strike. If I draw a payoff diagram of a call option, looks like this. That is long call. This is a strike, okay, from what we discussed last week. Then what if I go long a put option at the same strike price? Then your payoff diagram looks like this, isn't it? So this is the same strike price, long call, long put. Okay. Now, if I combine a call option as well as a put option at the same strike price, this is what it is going to look like. Okay. So this is long call and long put against the profit and the market. Okay, so just to test your understanding of options, I will ask a very simple question. This option strategy will make you money, right? You will make profits out of this option strategy if the market is stable or if markets are volatile. When will you make profits out of this strategy?
Volatile market.
Yeah. Sorry, you said when the market is stable, right? There is a 50% chance of success. I gave you two options. When the market is stable, you make profits, or when the market is volatile, you make profits. What is your answer? 50-50. I can also give you the call a friend choice. Yeah, you make profits when the market is stable or volatile.
Volatile markets.
Very good. Yes, you're right. Why? See, when the market is stable, it doesn't move much, no? Moves within a very small range, right? So if it moves within this range, the two break-even points, for as long as the movement is within that small range, then you will lose money, isn't it? Because this entire area is at a loss. So if market is within a very small, narrow range, you will lose. But if the market becomes volatile, that means movement are more violent, and it moves beyond these points, anywhere beyond, you make profits. Right? So if the market is volatile, then you make money. But if the market is stable, you lose money. So when do you think this strategy is useful? You should make use of this strategy when you feel the market is stable or volatile. Yeah, when the market is volatile. Right? When the market is volatile, you can make use of a strategy. You need to go long straddles. Right? It's called a long straddle. So long straddle is the combination of long call plus long put. Uh, can you all see? Yes, you can. You can see the board. Yeah. Okay. So long straddle is long call, long put. Now, when you have something like this, the next thing you need to look at is probably arbitrage. Right? There might be arbitrage opportunities if the straddle, for example, is priced at 10. Long call is priced at 8. Long put priced at 5. What would be your arbitrage strategy? Yeah. What would be the arbitrage? Is there an arbitrage here or no arbitrage? There is arbitrage or no arbitrage? Hello? Yeah. Is there an arbitrage here? There is no arbitrage. Hello. Yeah. What do you think? Arbitrage, can you all remember? Uh, Never heard of arbitrage? Yeah. The first thing is, does it add up? Hello? For as long as it does not add up, there is arbitrage, isn't it? There is arbitrage. What is arbitrage opportunity? How can you make use of arbitrage? What will you do?
It's the difference between long call and long short, long put.
Yeah. The right hand side is more expensive than the left, right? So what you need to do is you need to sell the expensive side and buy the cheaper side. So you can go short, call, short put, and go long, struggle. Yeah. So you can keep printing money that way. Okay, so this strategy is called long straddle. Now, can you remember we discussed about a trader called Nick Leeson?
Yes, yes.
Ah, thank God, I thought you would have forgotten. Right? That was 5 weeks ago. So you all are suffering from short-term memory loss. I was expecting you all to have forgotten.
Only in the very first day we discussed about
Very good, very good. At least one person can remember. Fantastic. Now, Nick Leeson was working for Barings Bank now. And this is the last product he did, the last derivative product. So some of you may have watched The Rogue Trader. So if you had watched The Rogue Trader, you would have seen that he went short straddles. That was the last thing he did. Right. Short straddle. Let's draw the diagram for a short straddle. Now, this is where he went wrong. Yeah, this is long. So short is the mirror image. This is the strategy that he got into, option strategy. Now, his expectation was that the market will be stable. If the market was stable, he would have earned the premiums and made some money. But remember, there was an earthquake in Kobe. Yeah, so that made the market volatile. The market crashed, in fact. If the market crashes, right, if it starts coming down, which option do you think will get exercised? The call option or the put option? Which option will get exercised? Yeah.
the other way around. That means
Hello. So which option do you think will get exercised if the market falls? The call option will get exercised or the put option will get exercised? when the market is coming down, the put option will get exercised, right? See, when the market falls and it's going down, it is the put option that gets exercised. Okay, so Nick Leeson, the put options that Nick Leeson sold got exercised. So that's how he got hammered. Clear? Any questions on this? Right. The next strategy is called as strangle. Now, straddle, you buy a call option and a put option at the same strike. But if you buy a call option with a slightly higher strike and a put option with a slightly lower strike, right? You increase the call option strike and reduce the put option strike. Then if you remember what we discussed last week, the call option premium will drop and the put option premium will also drop. Right? So you can then come up with a product which is slightly less expensive, little less expensive than a than a straddle. It's called a strangle, right? So there will be a small plateau where the loss will bottom out. It's similar to straddle, but the strike price for a call and put are different. Strike prices of the call and put are different. Strike price of the call is higher than the strike price of the put option. It's less costly than a straddle. Strangle is less costly than a straddle. Then you can develop strategies called spreads, right? That is where you combine call options and put options, or more than one call options, or more than two put options. A spread is a position which is entered by buying and selling equal number of positions of some class uh, uh, of the same class on the same underlying security, but with different strike prices or expiry dates. Right? So you can have bull spreads or bear spreads. A bull spread is designed to profit from the rise in the price of the underlying asset. Right? So if underlying prices are going up, you will benefit if you have entered into a bull spread. Okay, so that's what where you take a low strike call option plus a higher strike put option. Low strike call option you buy, go long, low strike call, and short, high strike call. Bull option spread is constructed by buying a call option with low strike and selling another call option with a higher strike price. Right? So you buy a call option with a low strike and sell a call option with a higher strike. So if the market goes up, you will benefit in this case. Right? I'm not going to great detail. Bear spread is the opposite. You buy a put option with a high strike and sell a put option with a low strike. You can do it using call options as well. Buying call options of a certain strike price and selling the same number of call options of a low strike price on the same underlying security with the same expiry month. Butterfly spread view is that the market will be traded within a range, right? So here you buy a call option at a low strike, sell two call options at an intermediate strike, and then buy a third call option at an even higher strike. So if the market is stable, then you make money in this case. If you look at the payoff diagram, you will see that if in the center stage, or when the market is stable, relatively stable, then you make profits. You buy an option, call or put at low strike price, sell two options at a high strike, and finally buy another at an even higher strike. Right, so hedging with options. Shall we try this example? How to hedge an underlying position. Right. Purchase a call to protect a short position, purchase a put to protect a long position. Let's see what it means. Let's try this example. A Japanese importer has to pay $2 million in 3 months. Right. The current yen rate is 90 and he thinks that the dollar yen rate will drop to 85. So what are your thoughts on this? Yeah, what do you think? Right, so Japanese import has to pay $2 million in 3 months. Right? And the current yen rate is 90. He thinks that it will drop to 85. So what do you think will happen? If the exchange rate drops, he will benefit or he will lose?
If exchange rate drops, he will lose.
Okay. Now he has to buy which currency? And what is his local currency?
It's USD. J,
Yeah, local currencies?
yes,
No, local
JP.
currency is the yen.
Yeah,
He needs to buy which currency? He needs to buy
dollar, dollar, dollar.
dollars. Yes. So if the dollar weakens, he will benefit or will he lose?
He will benefit.
He'll benefit.
Yes,
So exchange rate going to 85 means the dollar is weakening or strengthening?
weakening.
Dollar is weakening, right? Then he will gain.
Benefit. Yes.
Yeah, he will benefit, right? So if the exchange rate drops from 90 to 85, he will benefit. Um, then what has he got to do? Has he got to do anything? Hmm? Right. So if the exchange rate is coming down, he will benefit. No. If that is the case, has he got to do anything? Because he's already going to benefit. No. What do you think? Well, the issue is, although he's expecting the exchange rate to come down, there is no guarantee. There is no guarantee. No one can guarantee that the exchange rate will drop, right? Because these guys, they're not astrologers, right? You don't know what is going to happen in the market. You can't predict. No one can predict for sure. But you can. The expectation is that fundamentally, if you look at it, now this guy feels the exchange rate will come down, which is in his favor. But the risk is the exchange rate going up. Now, if it goes to 100 instead of going to 85, then he will lose. Right? So that's his risk. That's the risk that he's carrying. So to hedge that risk, what has he got to do? Then he needs to buy an option which will give him the right to buy the underlying. In this case, the underlying is the dollar, right? So he needs to buy an option which gives him the right to buy the dollar. So what is the option which gives you the right to buy? What option gives you the right to buy? Call option or a put option?
Call option.
Yeah, call option. So he needs to go long call option on the dollar, right? Long call option on the dollar. At what strike? What do you think the strike should be? Should it be more than 90 or less than 90?
Less than 90.
Yes, well, the answer is actually more than 90. Long call option on the dollar has a strike price more than 90. Less than 90. Now, this is the call option. Right. So this, let's say this is 90. Strike price 90. Anything above that, there is a profit. And anything below that is a loss. Now, if the strike price was 100, right, strike price was 100, that means somewhere here, and he's buying an option, right? He'll be buying an option which is out of the money. Currently, the market is 90. If you buy an option at 100, then it is out of the money option. But if you buy anything less than that, at 85, remember currently the market is 90. So if you buy an option at 100, it is out of the money. But if you buy an option at 85, strike price 85, then it is in the money. Now, the moment it becomes in the money, remember the premium is the intrinsic value plus time value. The premium is intrinsic value plus time value. So the moment you buy an in the money option, then your intrinsic value comes into play. Remember, it is the market minus strike, right? So whenever you buy options, you need to buy options which have zero intrinsic value. That means you need to buy options which are out of the money, so that you only have to pay the time value, right? If you buy options which are in the money, it's very expensive. In the money options are expensive. So whenever you do options, you need to buy options which are out of the money. Never buy options which are in the money. They are very expensive. Okay. So in this case, ideally, you need to buy an option which is out of the money. That means the strike price will have to be more than 90. That is what you need to say. You need to say you need to go long call option on the dollar, because there are two currencies. You can go long dollars or you can go long on the rupee. In this case, you need to buy dollars, so you need to go long call option on the dollar. The strike price of anything above 90, maybe 100. Right? That's what you need to say. Clear? Understood? Any questions on that? Any questions?
So could you repeat it again? In the sense, like in the money options are expensive because?
Yeah. In the money options are expensive because now if you go back to the option premium, right, premium is equal to the intrinsic value plus the time value, isn't it? Right? Remember?
Yeah.
Right. Now intrinsic value is the market price minus the strike, correct?
Yeah.
Correct? Intrinsic value of call option, what we did last week, market minus strike.
Yeah.
Okay. Right. So now, if you buy an option, a call option, which has a strike price of 85. Okay, currently the market is 90 now, isn't it?
Yes.
Yes. So currently the market is 90. Right. And you buy an option with a strike price of 85. It is already in the money. No?
Yeah.
Yeah. Right. So in the money by the market minus strike, 5. Already 5. Plus there is also time value. Now when you buy options, you always have to buy options which are out of the money options. Otherwise, you are paying a huge premium.
Okay.
So the protection you have is if the market goes up, right? If it goes up, now if your strike price is, let's say, 100, if the strike price is 100 and the current market price is 90, you will lose the premium, right? If it falls below 90. But if it goes up beyond 100, you have protection. Okay, that is the benefit you have. But if it falls, you're still okay. You can use the lower price. You don't have to use the option. Right? So what you need to remember is always buy out of the money options. If you don't buy out of the money options, see if this is out of the money, right? If your strike price is 100, this will be out of the money, no? Because the option, the call option price, the strike price is 100. This will be out of the money because the market is 90 now, right? If this is out of the money, then intrinsic value is 0. You only have time value. Right? So always buy options which are out of the money. Whether it's call or put, always buy an option which is out of the money. Never buy option which is in the money. Understood? The idea is to get an intrinsic value of 0. and to minimize the premium. Otherwise, you are straight away paying the difference. There is no point. It doesn't add any value, no? Straight away, you have to pay the difference. If you buy in the money option, you make a benefit of 5, right? If your strike price is 85, the market is 90, straight away you have a benefit of 5. But that benefit of 5 you are paying through the premium, isn't it? So it doesn't make a difference. It just makes the option expensive and does not add any value. Right? So you always have to buy out of the money options. Right? Because otherwise the profit you make, you are straight away paying away. Understood? Hello?
Yes, sir. Thanks.
Okay. Any more questions?
Sir, but when we want to buy an option, we don't know the spot price now, so we can't decide that intrinsic value.
If you buy an option?
So if we want to buy an option, we
Yeah.
don't know the spot price at that time it will prevail. So we can't decide the intrinsic value.
No, when you buy the spot price, you will always know. That is the only thing you will know. You will not know what it is going to be in the future. Right?
Spot price what we know is actually current spot price, not the future.
You want what you meant is the future spot price?
Yes.
Yes.
So that depending on that, no, that intrinsic value.
Yeah, that is true. But these options are tradable. They have a secondary market also. So if you want, you can sell this option also. So that is why the current this option will always carry a value, right? It always carries a value, and it has a secondary market. If you want, you can sell it off, right? So when you sell, you have to sell at the premium, and you receive the premium, right? That is why the current spot price is also important. You always base it on the current spot price. And if it's an American option, then anyway the current spot price comes into play. Yeah.
That means we have to get that intrinsic value at the time of selling that option.
Yeah.
Okay.
No. At the time of buying, at the time of selling, anyway you look at it. That is how the settlement happens, right? So if it's a European option, you can't exercise it right now, but you have to pay the premium upfront. The intrinsic value you have to pay upfront anyway. Isn't it? If it's European, and if you are not planning to sell it, you pay the intrinsic value upfront, right? So upfront you have paid intrinsic value. That means that amount you are going to lose, and you're going to exercise later on another 3 months. Then the market may have gone up, or gone down further. Yeah. So the actual benefit you recover when it matures is going to be totally different. Which means there is no point paying the intrinsic value today. It's better to buy an out of the money option, which is cheap. Right? In the money options are very expensive. Clear?
Okay.
Yeah. Good questions. So if the yen depreciates to 100, he needs to pay more yen to buy $2 million. He needs to purchase a dollar call yen put with strike price 95 expiring 3 months. If the market moves lower, he buys dollars cheaper. Right? If the market goes down, he doesn't have to exercise the option. If the market goes against him, he is protected by the call option. Shall we try this example? Sri Lankan exporter with dollar receipts in 3 months. Sri Lankan exporter, so he's getting dollars in 3 months. The current exchange rate 134.25, 3 months forward is 40 cents. So if he engages in a forward contract to sell dollars at 134.65, thinking that the dollar will drop against the rupee. Yeah, so go through this example. Right. So Sri Lankan exporter and he's getting dollars in 3 months. Current spot rate 134.25, 3 months forward rate 40 cents. So 3-1 forward is 134.65. Okay. So one thing he can do is to get into a forward exchange contract. That means he can book a 3-month forward rate to sell dollars at 134.65. Or he can buy an option. Which option do you think he should buy? What is the option he should buy? What option will you recommend to him? Yeah. Which option will you recommend? Call option or a put option?
Put option.
Yeah, put option. Very good. Why? Because you need to sell dollars, no? And the option which gives you the right to sell is the put option. Right? So you need to go long, put option on the dollar. Strike price should be what? Above 134.25 or below 134.25?
Below 132.20.
Very good. Below 134.25. Out of the money is below the spot rate, so below 134.25. Go long, put option on the dollar, strike price below 134.25. Now, if he gets into a forward exchange contract against getting into a put option, what are the differences? Which one is better? What will you advise him? Now, these are the things that you all must recommend to your customers, right? You know, banking business in the country is saturated. Everyone is offering the same products, very plain vanilla products. For the last 20, 30 years, we have been offering the customers the same products, FDs, savings accounts, current accounts, and loans, housing loans, import loans, export loans. Same product, right? So this is how you can differentiate yourself. You should go and talk to a treasury guys and see whether they can hedge the customer's risk. Right? Then you should also understand the customer's exposures. Is he an exporter or an importer? Has he got borrowings? Things like that you need to understand. Then you should understand the risk that he's exposed to. So once you understand these, then you should be a little proactive and figure out how to manage his risk. What are the products you can develop for this guy? Okay. So that the customer is also safeguarded, and then your organization also has a long-term customer, and you are able to make more money from you are able to milk the fellow. Right? So this is the value addition that you can make. Right. Now, going into getting into a forward exchange contract against a put option. What are the differences between the two? What happens when you get into a forward exchange contract, and what happens if you buy a put option?
So in a forward exchange, you are committed. Customer is committed.
Yeah, exactly. If you get into a forward exchange contract, it's like getting married. Right? There is no turning back. You're committed. Nothing you could do. But if you get into a put option, then it's like living together. No? We explained last week. Right? If you want, you can get married. Otherwise, you need not get married. You can forget about it. Right? There are pluses and minuses, but the only difference, the downside of an option is you have to pay a premium, whereas forward exchange contracts, no premiums. Right? So that is what you need to trade off. You need to strike a balance between the two. Are you going to go and pay the premium and do something like living together, or are you going to save your premium and get married? The choice is up to you. So he needs to buy an out of the money put option on the dollar.
So I have a small question.
Yeah.
When we select out of the money strike price, so we can lose also. No?
We can use.
We can lose also, no? Since if the prices goes below,
Yeah.
so we can we can lose also. No? So even though we buy at for lesser premium for out of the money,
Yeah.
but that we can.
Yes, you can lose, right? So if you buy, let's say, out of the money option, strike price 125, right? If the option gets exercised, then you will be selling at 125. Current spot price 134. So if you had booked a forward, yes, you will gain. But if you had booked forward and the exchange rate goes to 200, then what happens?
We are booking at 200 for forward.
Booking forward at 200. No, you're booking forward at 134.65, right? But if you don't book, you buy a option and the exchange rate goes to 200. Now, if you book a forward, you will be the rate will be 134.65, correct?
Yeah.
Yeah. Right. So if you don't book forward, then you could have sold it. If you hadn't booked forward, you could have sold it.
200.
Yes, you could have sold at 200. But if you had booked a forward, 134.65, isn't it? And then if you had purchased a put option, you would have sold it. If the market is 200, you will select
200.
200. Yeah. Right.
But he expect to the claim rates to go down.
Yeah, it depends on the customer's view. Now, in this case, the view is not given. Right? If he thinks the dollar rate will trade higher, that means if he expects it to go to 200, then he can do a put option. But if he expects it to go down, definitely it will go down. If he expects it definitely go down, there is no such thing. You can't predict 100%. No one can predict 100%. It depends on the customer's view. So best thing is to give the option to the customer. Yeah, give the choice to the customer rather than you deciding. You should give the pluses and minuses of both products, right? And explain it to him very well, and then let the customer decide what he wants. Right? That is where your job ends. You need to explain the products to him, give him the pros and the cons, and let him decide. Clear?
Yeah, so we do not have to think about the customer's view.
Customers?
We don't have to think about the customer's view, but the only thing we have to see it should be out of the money.
Customer's view. I'm sorry.
So, yeah, in this question it says that customer is a customer thinking that USD will drop, so we don't have to think about that.
No, you should check that also, what the customer's views are. Right? If the customer feels the dollar will drop, then probably he's better off doing the forward exchange. But if he feels if he's not sure, or if he feels the exchange rate will go up, then he should not get stuck with the forward exchange rate. Things like that.
Okay.
Yeah. Any more questions? So if the dollar trades higher, the option expires worthless. If the market goes against him, that means if the market goes down, he is protected by the dollar put and the rupee call. So let's try this one, the next question. The stock of A is trading at 100 rupees and fund manager sells 110 rupee calls for a 1 rupee premium. The fund manager will forfeit the participation in upside movement of stocks above 110. Why is that? Because this share is trading at 100 rupees. Right? And he's selling out of the money call options. And collecting a 1 rupee premium, right? So now this share is worth 100 rupees and he's collecting 1 rupee premium, right? That means his cost will reduce by 1 rupee. Actual cost will then be 99 rupees and not 100. So if it goes above 110, because the strike price is 110, he'll be selling at 110, isn't it? This is the current price. This is the strike. $110. For as long as it stays below 110, that is fine. Right? He will earn the premium. But if it goes above 110, he has sold a call option. Sold a call option means this option will get excised if it goes above 110. Right? So he'll be selling, in that case, he'll be selling shares of A at a price of 110 maximum. Now when he sells at 110, and if the stock goes to 200 rupees, he will not get the benefit because he is going to sell at 110. Right? So the maximum upside he will get is the 10 rupees plus 1 rupee premium, 11 rupees. Clear? He will not be selling anything above 110. Maximum selling price will be 110. Clear? Any questions? So the fund manager will forfeit participation in upside movement of the stock above 110. If the stock remains at the same level, he will have collected a premium of 1 rupee. By selling calls and collecting premiums, he can effectively lower the cost of the stock. This strategy is good only for stable and range trading markets. If the market moves down, he has to sell the stock at a much lower price. And if the market prices trade higher, he will have to buy back the stocks at a higher price. Right. Next one is zero cost options. Okay. Zero cost option is where you buy a call option and sell a put option. You buy one option, sell another option. The idea is now when you buy an option, you have to pay a premium, but when you sell an option, you receive the premium. So it becomes zero cost if the premium that you're paying is equal to the premium that you're receiving. Right? The hedger desires the limited risk offered by buying an option, but wants to avoid cash outflows. Right? He doesn't want to pay the premium. Combine the purchase of an option with the sale of another. That's called zero cost options. So let's try this. But before we go to zero cost options, now before we go to the example, it was a zero cost option that caused problems for CPC. Yeah, I think I explained last week. So what CPC did was they bought call options, let's say strike price 140. Then they sold put option, sorry, other way around. Other way around, I'm sorry. They sold put option at a strike price 140, let's assume. Then they bought call option. Let's say the strike price of 150. So this is what CPC did. Long put, strike 140. Short call, strike price 150. Right? So for as long as the market kept going up, there is no issue. So if the market went up to 150, they will be buying crude oil at whatever the market price. But if markets go beyond that, the maximum they will pay is 150. Right? So that's fine. They made some money there also, but then all of a sudden markets crashed, came down to about $40 a barrel. When it comes down, these put options got triggered. But all the banks started selling to CPC at a price of 140. Whereas if CPC wanted to actually buy from the market, they would have bought at a price of 40. So that is what went wrong. Okay. Any questions? No questions?
So in the CPC case, they have done the both put and call both. They have done.
Sorry?
In the CPC case, with CPC, they
Yeah.
have done both put and call option. Both they have done.
Yes, yes. They bought a call option, sold a put option. I wrote it the other way around. I'm sorry. Long call option and short put option. Right. So what would have happened is, now assuming call option premium was 10, put option premium was also 10. Right. They bought call option means they are paying a premium. Here they are receiving a premium. So the net is 0. Net premium is 0. That's why it's called. That's why it is called a zero cost collar. Right. Any questions? So let's try this example. In our previous example, $rupees 14.25. If you have used the dollar to go lower, you buy dollar put, rupee call at 113, and simultaneously sell dollars call, rupee put at 116, right? So this is how you construct a zero cost collar. Buy a call option, sell a put option. The key is to adjust the premium paid so that it's equal to premium received. Okay, so that's about options. Any questions on this? Okay, so before we get into futures, I'll do another small thing. Now we discussed forward exchange contracts. Right, so forward contracts can also be structured for exchange rates, interest rates, sorry, interest rates. And something like this. Like this is today. Let's say it's the 7th of August, right? We'll assume that your bank has a 1-year personal loan rate at 10%. Right? You're giving 1-year personal loans at a rate of 10%. So 1 year personal loan rate, 10%. Then let's assume you're giving 2 years personal loan rates at a rate of 12%. 1 year 10%, 2 years rate of 12%. Right, 1 year 10, 2 years 12. Now if a customer comes to you and if he tells you that he wants a 1 year personal loan rate starting 1 year from today, right? That means he doesn't want the loan today. He doesn't want his money today. He wants in 1 year time, 1 year's time, for a period of 1 year, right? So his loan will start only 1 year from today, and it will continue for a period of 1 year. Right? So if the customer comes to you, that means he's starting 1 year from today, and the loan will end 2 years from today. Yeah. Starts 1 year from today, and it will end 2 years from today. So you give the starting and ending points, 1 by 2. That means if you wanted it to start today, it will be 0 by 2. Then if you wanted it to start in the second year, it will be 2 and continue for 5 years from there, it will be 2 by 7. Likewise. Now in this case, he wants to start 1 year from today and finish the loan 1 year, 2 years from today. So it's called 1 by 2. Right? Now if he comes to you for this product and he asks you what is the rate at which you are willing to lend 1 year from today, what will you do? What will you quote? What will you quote for this period? What will your rate be? Let's say it is R. What is your rate? How much will you quote? For a 1 year personal loan rate starting 1 year from today, how much will you quote? Yeah, what do you think? What would be your rate? You got the question? What would be your rate? How would you calculate? So will it be 14% so that you average at 12%? You charge 10% 1 year, then you give the loan for the second year, you charge 14%, on average you get 12%. Is that how it works? No. what happens is, now if you lend 100 rupees under two methods, one is at 12%, right, for 2 years, or you lend 100 rupees for 1 year 10%, and then for 2 years at for another 1 year, right? 1 year 10%, then for another 1 year R. The two effects should be the same for you to be indifferent, which means 100 into 1 plus 10% times 1 plus R should be equal to 100 into 1 plus 12% square. Right. So this cancels off and gives 1.1 times 1 plus R equals 1.12 square. And R would be 1.12 square over 1.1 minus 1. $14.04%. That is the rate that you need to quote. 14.04%. Okay, any questions? No? Now the next question is, why will your customer come today and why will he want to book a 1 year rate 1 year from today? Why will he want to do that? Why do you think he will want to book a 1 year rate 1 year from today?
Because he expecting further increase in interest rates?
Yeah, because he expects the interest rates to go up after 1 year. Right? After 1 year, he expects interest rates to go up. That's why he wants to fix it here. Now, in your case, if you want to take a housing loan, and if you feel interest rates are going up, will you prefer to take the housing loan now or later, after rates go up? Obviously, you prefer to take it now, right? So for the same reason only, he's booking the 1 year forward rate now, because he feels interest rates will go up. Right. Now, he has booked a rate of 14.04%. So after 1 year, if the rate is 15%, right, after 1 year, if the 1 year FD rate is 15%, what will be the impact? Will he gain or will he lose?
He will gain.
He will gain because he has agreed to borrow at 14%, 14.04, whereas after 1 year the rate is 15%. So how will you calculate the gain? How do you calculate? Yeah, he has a benefit of 14.04, isn't it? 14.04% benefit. Right. So over a period of 1 year, right, over a period of 1 year, he will have a benefit or a saving of almost 1%, 0.96%, right? Borrowed amount is 100. So this will give you the saving in dollars. Now, when is he getting this benefit? He is getting this benefit upfront or at the end?
At the end.
Yeah, at the end. Right, at the end. But you want to calculate the benefit today itself because you can figure it out. Okay, so this is the rupee benefit. Then you need to discount it. 1 plus market is 15%. That will give you the present value of his benefit. Comes out to 0.83. Okay, so if interest rates go up, he will benefit, and if rates go down, he will lose. Okay. So this is called a 1/2 FRA, forward rate agreement. Or a FRA. Like exchange rate forwards, this is the version of a interest rate forward rate agreement. Or FRA. Okay. Any questions on this? No questions? Right. Now in this case, this customer is the borrower. Okay. So in FRAs, the borrower is the person who is using the rate, he is long. And the lender is the one who is quoting the rate, he is short. Okay, so like options, you have long and short. Borrower is long and the lender is short. Any questions on this? And in this case, it starts 1 year from today and it continues 2 years down the line. So it's called a 1/2 FRA. Clear? Any questions? No questions? Okay. Right, so the next area is on futures. Now for your exam, you want some tough questions or easy ones? Yeah. Hello? Do you prefer to get tough questions or easy questions? Anything doesn't matter? No? Any exam is going to be easier. Huh?
Easy question.
Difficult.
Easy question.
Easy questions. Okay. Anyway, the areas we covered is very simple, no? So, yes, you will get easy questions, right? Practice all the areas. Right. So, shall we take a break and come back? Now it is 3:25. We'll come at 3:45. Yeah. Okay. So let's have a break. We'll come back at 3:45. Okay. So the next area is on futures. Yeah. Now, futures are also quite an important area because most of the transactions we do, like purchasing crude oil, right, happens using futures contracts. Most of the futures contracts are non-deliverable. That means there is no physical delivery, only cash settled. Right. So the main difference between forward and futures is a forward contract is over the counter. Forwards are over the counter contracts. Forwards, they trade over the counter, OTC. Whereas futures are exchange traded. Exchange traded. So this is the main difference between forward and future. When a transaction is over the counter, the features can be customized. Whereas exchange traded contracts are standardized. Right? Over the counter can be customized. Exchange traded will be standardized. Standardized meaning everything is standardized, right? Whether it's now, for example, if it's crude oil, then the delivery port is standardized. The delivery date is standardized. The sulfur content of the oil is standardized. Everything, every detail is standardized. The forward contract is an agreement made today between a buyer and a seller who are obligated to complete the transaction at a future date. The buyer and the seller know each other, unlike a futures contract. the negotiation process leads to customized agreements. What to trade, where to trade, when to trade, how much to trade, all can be customized. That's the most important thing. The price at which the trade will occur is also determined when the agreement is made. This is known as the forward price. One party faces default risk, right? So when it's forwards, there is default risk. Default risk is present. Whereas for futures, settlement is guaranteed. Default will not occur. One party faces default risk because the other party might have an incentive to default on the contract. Right? To cancel the contract, both parties must agree. Basically, it's like a divorce. If you get into forward to cancel it, it's like a divorce. Both parties have to agree. Otherwise, there will be legal battles. One might have to make a dollar payment to the other to get the other side to agree to cancel the contract. A futures contract is an agreement made today between a buyer and a seller who are obligated to complete a transaction at a future date. Very similar in that sense, right? Because there are obligations on both sides. Unlike an option, the difference is the buyer of an option has a right without an obligation, whereas the seller has an obligation. Right. So coming back to futures, the buyer and the seller do not know each other. Right? It's like trading on a stock exchange. You don't know who is selling. The negotiation occurs in the fast-paced frenzy of a futures pit. The terms of a futures contract are standardized. Right? Futures are standardized contracts. What to trade, where to trade, when to trade, how much to trade, what quality of good to trade, all standardized under the terms of the futures contract. Financial futures are usually cash settled, although physical delivery is not impossible. So they're always usually cash settled, 99.9% cash settled. The price at which the trade will occur is determined in the pit. This price is known as the futures price, right? So trades are done in a place called a pit, right? It's not like a toilet pit. It's a very posh place. The only thing, people start shouting, lots of noise. Right? No one faces default risk, even if the other party has an incentive to default on the contract. Right? Whatever happens, there is no default. No one will default. The futures exchange where the contract is traded guarantees each trade and no default is possible. The futures trade or the futures pit guarantees settlement. Sorry, the futures exchange guarantees settlement. To cancel the contract, an offsetting trade is made in the pit. The trader of a futures contract may experience gains or losses. So this is a little bit of history about futures. And everything started with agriculture to hedge the risk of agri-produce. And these are the major exchanges where futures trade. Futures contracts must stipulate at least the following terms: the identity of the underlying commodity of financial instrument. Right? What is the identity? Crude oil, 95% sulfur. The futures contract size. Okay, so if it's crude oil, it trades in lots. So one lot of crude oil is 1,000 barrels. How many lots are you buying? You can't buy 1.5. Like buying a loaf of bread, you can't go and ask for 1.5 loaf of bread. No. Futures, you have to buy the full thing. You can't buy bits and pieces. The futures maturity date, also called the expiry date or the delivery date. The delivery or settlement procedure, cash or physical. Then the futures price. Okay, so these are some of the main futures contracts. If you look closely, You might notice that there are all types of futures: grain, petroleum products, interest rates, indices. Right? There are more. Can be metals, currencies, exchange rates, stock exchanges. Even the weather is there under futures. A futures contract represents a zero-sum game between a buyer and a seller. Gains realized by the buyer are offset by losses realized by the seller. Right? So, like an options contract, remember last week what we discussed? It's a mirror image. Each of them will have mirror images of others' positions. Right? So if the seller makes a loss, that means the buyer has a gain. If you add the two, zero. The gains realized by the buyer are offset by losses realized by the seller. The futures exchange keeps track of gains and losses every day. Futures contracts are used for hedging and speculation. Hedging and speculating are complementary activities. Okay, that is because hedging means you try to manage your risk. Speculating means you take on risk. So what usually happens is the hedger will pass on the risk to the speculator. Hedgers shift price risk to speculators, and speculators absorb price risk. Buying a futures contract today is often referred to as going long or establishing a long position. Each futures contract has an expiry date. Every day before expiry, a new futures price is established. It's called mark to market. Right? Futures are mark to market on a daily basis. It is done by the exchange. If this new price is higher than the previous day's price, the holder of a long futures contract position profits from his futures price increase. Right? So if the price you buy and the price goes up, obviously you will gain. And you sell and the price goes down, you will lose. If this new price is lower than the previous day's price, the holder of a long futures contract position loses from this futures price decrease. Right? So if you buy and the price goes up, you will gain. You sell and the price goes down, you will lose, obviously. Let's go through this example. So it says you believe the price of gold will go up. So you go long 100 futures contracts that expires in 3 months. Right? Now, if you feel the price is going to go up, you should buy, isn't it? You feel the price of vehicles are going up. The best thing you should do is to buy vehicles before it goes up. Right? But if you feel the price will come down, then you will not buy a vehicle. You will wait until the price drops and then buy. Or you will sell the vehicle that you have. You believe the price of gold will go up. So you go long 100 futures contracts that expires in 3 months. The futures price today is $400 an ounce. Futures price today is $400 an ounce. So you are buying 1 ounce at $400. There are 100 ounces of gold in each futures contracts, and you are going long 100 contracts. That means 100 into 100, you are long 10,000 ounces of gold. Your position value is 4 million, right? Because each ounce is $400, right? And in one futures contract, you have 100 ounces, so that is 40,000. And likewise, you are buying 100 contracts. So that's 40,000 into 100 is $4 million is your initial outlay. Suppose your belief is correct and the price of gold goes to 420, right? So you bought for 400, the price goes up to 420. Then you make a $20 profit. Okay. Into 10,000. $20 into 10,000 is $200,000 profit. Isn't it? You make a $200,000 profit. Your long speculation has resulted in a gain of $200,000. And there's a question, what would have happened if the price of gold went to 370? What do you think? If the price of gold dropped, what happens?
Loss of 300,000.
You will? Yeah?
Loss of 300,000.
Yes, you will lose 300,000, right? Because you bought for 400 and $400 an ounce, then the price drops by $30 an ounce. You bought for 400, price drops to 370, so you're losing $30 an ounce into 100 ounces per contract, and you're buying 100 contracts, which comes to a loss of $300,000. Okay. Clear? Any questions? No questions? Selling a futures contract today is often called going short or establishing a short position. Each futures contract has an expiry date. Every day before expiry, a new futures price is established. Right? So again, mark to market happens. Whether you go long or short, it will get mark to market. If this new price is higher than the previous day's price, the holder of a short futures contract position loses from his futures price increase. Right? That means now, for example, if you assume that the prices of vehicles will go down, so you sell your car immediately, you sell, but all of a sudden there is a tax and prices go up, right? Then you will lose because you have to buy another vehicle at a higher price. So it's something like that. Go short, price goes up, you will lose. If this new price is lower than the previous day's price, the holder of a short futures contract will make a profit. Right, so let's go through this question. In this case, you believe that the price of gold will go down. If you feel the price is going to go down, should you buy or should you sell? What do you think? If you feel the price is going to go down,
Sell.
you need to sell, right? So you go short. 100 futures contract that expires in 3 months. The futures price today is $400 an ounce, and there are 100 ounces of gold in each futures contract, similar to what we discussed last week, earlier. So your position value is 400. You're selling $400 an ounce into 100 ounces per contract into 100 contracts, $4 million. So you have sold gold means you will receive $4 million. Now to square off your position, you have to buy back the gold. Suppose your belief is correct and the price of gold goes to 370. You sold at 400, the price comes to 370, right? And you are sold at a higher price, so you make a $30 profit into 10,000. You make a $300,000 profit. But what happens if the price of gold goes up to 420? Then what happens? Yeah, you sold and the price goes up. You make a profit or a loss. What happens if you sell and the price goes up? You sell your vehicle for 1 million rupees and the price goes up to 2 million, you will profit, you'll make a gain or a loss. Hello. Hello. You make a loss, right? You sell it and the price goes up, you will obviously lose. So what happens if the price goes to 420? Profit or a loss?
That's up to 100,000.
Yes. You sell it at 400, then the price jumps to 420, you will lose. Right? You lose $20 an ounce into 10,000 is $200,000 loss. A hedger trades futures contracts to transfer price risk. Right? So if I'm hedging, my objective is not to take the risk, but to transfer it to someone else. Hedgers transfer price risk by adding futures contracts positions that is opposite to an existing position in the commodity or financial instrument. When the hedge is in place, the futures contract throws off cash, and when cash is needed, the futures contract absorbs cash when cash is available. Right? So let's see what it means. A company has a large inventory that will be sold at a future date. So the company will suffer losses if the value of that inventory falls, isn't it? Because if, for example, if you're selling water bottles, right, and all of a sudden there is a price ceiling or whatever that comes on the price of a bottle, and prices drop, then the inventory value will fall, right? So the balance sheet value will fall. They'll take a hit. Suppose the company wants to protect the value of the inventory. Selling futures contracts today offsets potential declines in the value of the inventory. The act of selling futures contracts to protect them from falling prices is called short hedging. Let's try this example. Starbucks has an inventory of about 950,000 pounds of coffee valued at $57 per pound. They fear that the price of coffee will fall in the short run and want to protect the value of this inventory. So let's see what can be done. They have 950,000 pounds at 57 cents. It's worth 541,500. This is the long inventory, means the short dollars 541,500. They fear that the price of coffee will fall in the short run and wants to protect the value of its inventory. There is a coffee futures contract at New York Board of Trade. Each contract is 37,500 pounds of coffee. Coffee futures, right? So they have inventory, 950,000 pounds of inventory. Now the risk is what? The price of inventory going up is a risk or going down is a risk? What is the risk? Yeah. what is the risk they are exposed to?
Price reduction.
Price going down is a risk, right? So if price going down is a risk, they have to get into a position which gives them a profit when the price goes down. And so for you to make money when the price goes down, that means you have to get into a short position. So what they can do is they can short some of these futures. There is a futures contract at New York Board of Trade. Each contract 37,500 pounds of coffee. So how many pounds do they need? How many contracts do they need? 950,000 divided by 37,500. For 25 contracts, right? Uh, 37,500 pounds of coffee in each contract. Coffee futures price with 3 months expiry is 58 cents. Right? Then let's see the coffee futures. Okay. $25 into 37,500 into 58 cents. And they need to go short. Which is 543,750. Right. So selling futures contract provides inventory protection. That's what they've gone short futures.
So why is it 58? 58 is in 3 months expiration.
Yeah. But for the futures, you have to pay today itself. And the futures will expire in 3 months. Current price, if you're buying these futures, is 58 cents. Okay. It's not that you have to pay 58 cents in 3 months. Today, for you to buy, you have to pay this. You can buy it at 58 cents.
Okay.
So Starbucks decides to sell 25 near-term futures contracts. Each contract has 37,500 pounds, each valued at 58 cents. So they will receive 43,750. Over the next month, the price of coffee falls, right? So the inventory price will fall. Starbucks sells its inventory for 51 cents. Then 1 month, inventory they will sell at 51 cents. They will make $484,500 when they sell it at 51 cents, right? So the inventory position is 0, and dollars they will lose. $57,000. The futures price also falls. And futures was 58 and the price is falling to 52 cents. 1 month. So they will buy back 37,500 futures pounds of the futures, 25 contracts, each has 37,500 pounds at the price of 52 cents. Right, so the futures position is 0 and they will spend $487,500. So they minus 56,250. Sorry. They make a profit of 56,250. Okay. Then on inventory, they are losing 57,000. On coffee, they are making 56,250. The net minus 57,000 plus 56,250. $750 loss. Okay, so they will end up losing $750. Okay. Now, without this hedge, if they had not done the coffee futures, how much would they have lost? If they hadn't done coffee futures, they would have lost
57,000.
57,000. But now, because of the futures, they have saved out of that 56,250. Right, so they end up losing only $750, which is much better than losing $57,000. Right. So they have saved some money there. Clear? Then the next question is, what would have happened if prices had increased by 6 cents? What would have happened if prices had increased by 6 cents? Yeah. If prices had gone up, by 6 cents, it will be 64 cents, then 63. $598,500. So on inventory, they make a profit of $57,000. Then on the short futures, they make 600,000. So it's going to be minus, so here it is minus. And the net will be a $750 profit. Now what would have happened if they didn't have the hedge? What would have happened if not for the hedge? Yeah. If this hedge was not there, they would have made a what? Profit of $57,000. Right? But because of the hedge, they make only a profit of $750. Isn't it? Right. So in this case, the hedge has lost money, has resulted in them losing some money. Right? They could have made $57,000, but they end up only with $750. By hedging, they have lost money. So what do you think is best? Because hedging does not mean you have eliminated your risk. Right? Even if you hedge, you might lose your risk. The only thing it does is it reduces the volatility. Right? Because instead of a huge gain or a huge loss, you will make either a very small gain or a very small loss. So if you want to reduce volatility, then you can use derivatives. Clear? Any questions on that? No questions? Okay, so let's move on. A company needs to buy a commodity at a future date. The company will suffer losses if the price of the commodity increases before, right? So it's like if you want to buy mangoes next month, and if the price of mangoes go up, you will lose. Something like that. That is, they paid more than they should have. Suppose the company wants to fix the price that they will pay for the commodity. Buying futures contracts today offsets potential increases in the price of the commodity. The act of buying futures contracts to protect them from rising is called long hedging. So earlier you were short hedging, right? You sold. Now you are buying, going long. Let's go through this example. suppose Nestle plans to purchase 750 metric tons of cocoa next month. They fear that the price, okay, now they want to buy the inventory next month. They haven't bought it yet. So what is the risk? The risk is the price going up or going down.
Going up.
Yeah. Going up is a risk, right? You have, like if you want to buy a vehicle and you postpone your decision until next month, and all of a sudden if the price goes up, you will lose. Nestle fears that the price of cocoa, which is $1,400 per ton, will increase before they acquire the cocoa. They want to fix the price it will pay for cocoa. How best to do this? This cocoa futures contract at New York Board of Trade. Each contract is 10 metric tons of cocoa. Cocoa futures will, with 3 months to expiry, is 1,440 per ton. Buying futures contracts provides inventory acquisition price protection. Okay. $750 metric tons at 1,400. Now the risk is the price going up. So they have to go either long or short, right? And to hedge their risk, the position they take should make profits if it goes up, right? Because the risk is price going up, so they need a product which gives them a profit when the price goes up. So should they go long or short futures? They have to go long. They go long futures because if they go long and the price goes up, they will benefit. Each contract 10 metric tons. That means they need 75 contracts, each 10 metric tons. $1,440. So they're going long. this place, they have not bought it yet. Meaning they have $1,050 with them, right? The buying futures contract today provides acquisition price protection. 75 futures contracts covers 75 metric tons. That's fine. So Nestle decides to buy 75 near-term futures contracts. Over the next month, the price of cocoa increases and Nestle pays $1,490 per ton for its cocoa. So in 1 month, they will buy 750 metric tons at 1,490. Right. So because of cocoa prices going up, they will lose $67,500. The futures prices also increased to 1,525. Meaning they can sell it at 1,525. They will make 1 million. $63,750. Right. So your net is minus 67,500. A loss. They end up with a loss of $3,750. They will lose 3,750. Okay. Now, if not for this, if not for the futures, or if not for the hedge, how much would they have lost? If they hadn't entered into futures, or if they hadn't hedged, how much would they have lost?
$67,500.
Very good. But because of the hedge, they managed to save some money, right? What would have happened if cocoa prices fell by 85 and futures prices fell by $90 instead? Right. So if cocoa prices fell by 85, say from 1,400, it will come down to 1,315. And if future prices goes up, fell again, also falls by $90. 1,350. Then what happens? Sorry, if it falls, then they will make money on the inventory, and the futures they will lose, right? So net is again $3,750 loss, right? So once again, if not for the futures contracts, they would have made a profit of 63,750. But because of futures, they end up losing 3,750. Okay, so just because you get into futures or you hedge, it doesn't mean you have zero risk. Okay, any questions on that? No? A futures exchange is like a stock exchange. It allows only exchange members to trade an exchange, right? So you have to get registered with the futures exchange. Exchange members may be firms or individuals trading from their own account, or they may be brokerage firms handling trades for customers. The important aspects of futures trading accounts, well, it's like when you open a current account, right, you have to have a minimum balance. Then to open the account, you need the minimum deposit amount, maybe 25,000 bucks or whatever. And you have to keep it at a minimum of maybe 10,000 rupees, right? So those requirements are there. Otherwise, you get hammered on a service charge. So likewise, if you are operating a futures account, still you have the same requirements, right? You have to maintain an initial balance. That amount has to be deposited initially. Then if the account balance falls below a certain amount, you have to top it up, right? So it's called a margin requirement, right? You need initial margin as well as maintenance margin. Initial margin is the amount that has to be deposited initially. The contract values are marked to market on a daily basis, and the margin call will be issued if the balance falls below the maintenance margin. Maintenance margin is a minimum balance. Futures position can be closed out at any time. This is done by entering a reverse trade. In the hedging example, Starbucks and Nestlé entered reverse trades at the time they adjusted inventories. In those examples, the futures contracts had 2 months left before expiry. Okay, so there are two margins, initial margin and maintenance margin. So to start with, you need to deposit initial margin. And the minimum balance is called maintenance. Right, so you start with the initial margin, then your account balance can keep fluctuating. But if it falls below the maintenance margin, they will issue what is called a margin call. So the very next day, you have to top it up to maintenance margin. Right? And the amount you need to deposit is called the variation margin. The variation margin. Initial margin is required when a futures position is first established. Initial margin. It depends on the price volatility of the underlying asset and can differ by the type of trader. When the price of the underlying assets change, the futures exchange adds or subtracts money from trading accounts. Right? That's called marking to market. When the balance in the trading account gets too low, it violates maintenance margin levels and a margin call is issued. Right? Margin call is issued here. A margin call is simply a stern request by the broker that more money needs to be deposited into a trading account. Right? So let's go through this example. Martin opens a trading account with ABC Brokerage. He believes gold prices will increase. Should he go long on gold futures or short? What do you think? He should go long or short? If he feels the price is going to go up, should he go long or short? Yeah. If you feel the price is going to go up, should you go long or should you go short?
Long.
Yeah, you have to go long. Very good. There are 100 ounces of gold in gold futures contracts. So ABC requires an initial margin of $1,000 per contract. and a maintenance margin of $750 a contract. Right. So Martin is depositing the initial margin in his account. The futures exchange keeps daily records that marks all trading accounts to market. Okay, so today he is depositing $1,000 in the account today. Right. And he has a $250 cushion between initial and maintenance. Then on the first day, gold trades at $400 an ounce. Okay. So he's buying 100 ounces of gold, right? 100 ounces of gold at $400. So on the first day, let's assume there is no change in the price. So it closes at $400. Then day 2, the price has dropped by $2. He has bought at 400, price drops by $2 to $398. So he will lose $2 into 100. $200 lost. Right? His account balance. On the second day, it will drop to started at $1,200 lost. It will drop to $800. Right, $200 taken out of his account. Third day it drops by another $4. So he will lose day 2, 200, day 3, $400. 800 minus 400. Still, by the way, on the second day, still above the maintenance, so no margin call. Another $400. Now his balance falls below maintenance, right? So margin call will be issued on the third day, and on the fourth day, he has to top it up to the initial margin. Meaning from $400, he has to top it up by $600, $2,000. Clear? So that's how the margin account operates. Any questions? Any questions on futures? So what happens on the next day if the price let's say day 4, if the price is 400, then what happens? From 394, if the price goes to $400 on day 4, what happens? Yeah, another $600 will get added. Right, it's 394 to 400, $6 into 100 ounces, $600. So therefore, actual closing balance will be another $600 on top. It will be 1,600. That's how the futures account works. Clear? Any questions on that? No questions? Next one is on swaps. Right. Once again, there are swaps, all sorts of swaps. Fixed to a floating swap, interest. Well, it's called interest rate swaps, exchange rate swaps, debt to equity swaps, right? Credit default swaps. You name it, you have various kinds of swaps. So many types. In a swap, two counterparties agree to a contractual arrangement wherein they agree to exchange cash flows at periodic intervals. Notional principal is a reference amount used only to calculate interest expense but never repaid. Right? Remember, in a swap, except in a currency swap, in all other swaps, the notional value is never exchanged. Never exchanged. It's only used to calculate interest rates, interest payments. There are two types of interest rate swaps. Single currency interest rate swap. Plain vanilla fixed for floating swaps are often just called interest rate swaps. Okay, now the other type is cross currency interest rate swaps. Okay, single currency interest rate swap. Now, take for example, if you have taken a housing loan, right, on a floating rate basis. If interest rate starts going up, you will prefer to continue with your floating rate, or will you want to switch to a fixed rate? If interest rates start going up, what will you want to do? Will you want to, are you going to be, will you be willing to continue with the floating rate, or will you prefer to switch to a fixed rate? Yeah.
Prefer to go to fixed rate.
Yes, you prefer a fixed rate, right? Then if you have a fixed rate housing loan, right, and you see that interest rates are going down gradually, what will you prefer? You prefer to continue with the fixed rate, or will you prefer to switch to a floating rate?
Floating rate.
Yeah, obviously floating. Right? Swaps can be used. Well, actually, swaps can be used to switch from fixed to floating or floating to fixed. Now, how does it happen? Let's assume you have a 10 million rupee housing loan, right? And you're paying interest. You're paying interest at a rate of, let's assume a fixed rate of 10%. then you notice interest rates are dropping. Interest rates are coming down. Now, you will not want to continue your housing loan at a rate of 10%. Right? So what you do is you go to a bank, and you tell them that you will prefer to go from paying a fixed rate to paying a floating rate. Now, this need not be the bank that you had the original loan arrangement with. You can go to another bank. Right? So the bank will tell you, will ask you what is your loan amount or the notional value. You will say 10 million. Then the bank will tell you, right, on a monthly basis, we will pay you PLR, right? And you pay the bank a rate of 8%. Sorry, what am I saying? Right. Sorry, I come again. Now, this is the original arrangement. You are paying a loan of 10%. This is your loan. You're paying on 10 million, you're paying 10%. So you're not happy with that. You want to switch to a floating rate. So you approach a bank and you tell them that you want to pay a floating rate on your loan. Right? So they will structure it so that, and they will ask you to pay on a monthly basis PLR plus 2% to the bank. Right? And the bank will agree to pay you on a monthly basis at 9%. On what? Interest is calculated on the notional amount, the 10 million, original 10 million. Right? So you're paying PLR plus 2% to the bank, and the bank is paying you 9%. Now, if you look at the net payment, what is happening? What is the net payment? See, the original loan, you're paying 10%. Then from this bank, you're receiving 9%, and you're paying PLR plus 2%. Right? So your net, you will end up paying PLR plus 3%. Isn't it? Okay. Is that clear? So originally you were, yeah.
It tends to be PLR 1%.
PLR
1%, no?
plus 1%.
Yes.
Right. See here the net is you're paying 1% out, right? You're receiving 9% and paying 10% means you're paying 1%. No? Correct? Here you're paying PLR plus 2%. So that 1% plus PLR plus 2% is PLR plus 3%. Clear? Isn't it?
We are paying 10% to bank.
Yeah.
We are receiving only 9%, so we have to another 1% is there.
Yeah, 1% you are paying, no? Net.
Yeah.
Yeah, then here you're paying PLR plus 2%, right? Again, you're paying PLR plus 2, no?
Yeah.
And then another 1% you're paying there, right? So it comes to PLR plus 3. Isn't it? Hmm?
Okay.
Yeah. Right. So original loan was a fixed rate loan, 10% you were paying. Fixed, no? But now you are paying PLR plus T. PLR plus T is fixed or floating? It's a floating rate. Right. So you have switched from paying fixed to paying floating. Right. Now the second scenario. Let's say your housing loan, 10 million, and you are paying PLR plus 2% interest on it. Right? So your risk in this case is interest rates going up or going down. When you're paying floating, the risk is when you're paying a floating rate, your risk is what? Interest rates?
Increasing.
Yes. So you expect interest rates to increase. If you feel interest rates will increase, you go to the bank, right? And you tell them that you want to switch from paying floating to paying fixed. If interest rates are increasing, you prefer to pay fixed rather than paying floating. Right? So the bank will do an arrangement where they will tell you that the bank will pay you PLR. Right? You will receive PLR from the bank. And the bank will ask you to pay them a rate of 10%. Right? The bank will ask you to pay them a rate of 10%. Now, if you look at the cash flows, original loan you were paying PLR plus 2%. Then from the bank you are receiving PLR and you're paying 10%. So your net is PLR cancels off, you're paying 12%. You end up paying a rate of 12%. Right? Okay. So if you are paying fixed rate of 12%, the moment PLR goes above 10%, you will gain. Right? If it goes to 11%, you would have paid 13, but now you pay only 12. You will gain. Whereas in this case, you are paying 10%. So if the PLR falls below 10%, 7%. Right? If it falls below 7%, then you will gain. Isn't it? So that's how swaps work. You can switch from paying fixed to paying floating. Another way of doing a swap is, now let's say you are a fund, right? You are a fund, you have invested in bonds. If you didn't have a mandate to sell the bonds and buy equity, if you are invested in bonds, your return will be the bond return. And if you feel that equity markets will outperform bond markets, what you can do is you can go to a bank and for a notional amount of, let's say, 1 billion, you can structure a swap where the bank pays you equity return, maybe the stock market return. And you agree to pay the bank the bond return. Right? So the net cash flows will be, here you're paying bond return, you're receiving the bond return, and here you're receiving equity return. So you end up with an equity return. That's called a debt to equity swap. You have swapped from debt into equity. Clear? Any questions on that? In a swap, two counterparties agree to a contractual arrangement wherein they agree to exchange cash flows at periodic intervals. Notional principal is a reference amount used only to calculate interest expense, but never repaid, right? And finally, swaps can be used to hedge and can be viewed as a portfolio of futures with different maturities. Right, so there are some similarities between derivatives. One can be used to construct another. Let's have a look at this example. Bank A has a is a AAA rated international bank located in UK and wishes to raise $10 million to finance the floating rate euro-dollar loan. Bank A issued 5-year fixed rate euro-dollar bonds at 10%. It, however, prefers to issue a floating rate note. B is a BBB rated US company. It needs $10 million to finance an investment with a 5-year economic life. B issued a 5-year floating rate note at LIBOR plus 0.5%. It, however, prefers to borrow 5 years at a fixed rate. Now, these two have opposing requirements, right? A is based in UK and wants to raise $10 million, whereas B is based in US and wants to raise it also wants to raise dollars, right? So these are the borrowing opportunities for the two companies, A and B. If because of A's higher credit rating, it can always borrow at a lower rate. A will borrow at 10% fixed and 11.75% floating. B will borrow LIBOR plus 0.5% floating, and A will borrow at LIBOR floating. Now, this, according to this table, B has a comparative advantage over borrowing fixed rate, because if they borrow on a floating, they'll have to pay only 0.5% premium. But if they borrow at a fixed rate, they'll have to pay 1.75% premium, right? Now, Swap Bank makes this offer to A. They will pay LIBOR minus 1/8 for $10 million for 5 years. Sorry, they're asking A to pay them LIBOR minus 1/8 for a year on $10 million for 5 years, right? And Swap Bank will pay A 10.3 on $10 million for 5 years. So every year, these interest rates will be paid. Right? So A can borrow externally at 10% fixed cost and has a net position of, if you do the workings like what we did earlier, 10.3 minus 10 minus LIBOR minus 1/8, right? So they end up paying LIBOR minus 0.5%. Now earlier they were paying 10%, remember, which is a fixed rate, and they have switched to a floating rate. So they have switched from paying fixed to paying floating. So this is 0.5% better than they can borrow using floating rate swap. Okay, that's a saving of about $50,000 a year. Then for B, this bank offers B this proposition. They're asking B to pay them 10.5%, right? And they will pay B LIBOR minus 0.25% for 5 years, right, sir? Now B can borrow externally at LIBOR plus 0.5%. And have a net borrowing position of 11.25%. So they have switched from LIBOR plus half to 11.25%. That's basically a floating rate or fixed rate switch. Okay, and it will save them $50,000 a year. Swap bank makes money too, based on the spreads, right? So look at this working. It's not rocket science, it's quite simple. So eventually what has happened is they have switched from paying floating to paying fixed, or vice versa, right? So that's called an interest rate swap. You switch from paying fixed to paying floating, like what we discussed just now. You also have currency swaps, right? Currency swaps is the only instance where you exchange cash flows when it comes to swap. So the notional is exchanged only in the case of currency swaps. In no other circumstance do you exchange your cash flows or the notional amount. Suppose a US multinational company wants to finance $10 million expansion of a British plant. They could borrow dollars in the US where they are well known and exchange for dollars, exchange for pounds. Or they could borrow pounds in international bond markets but pay a premium since they are not very well known abroad. And so what they need to do is they need to find a company which is located in UK, which has the mirror image position. So if they find a British multinational with a mirror image financing need, they may both benefit from a swap. Right? And the exchange rate is $1.6 per pound. Right, so A and B, these are the borrowing lines that they have. A can borrow in dollars at 8, pounds 11.6. B can borrow dollars at 10, pounds 12%. Right. So what A will do is they will give the sterling to swap bank. Sorry, A is a US company. They will give the dollars to swap bank, and on that they will receive 8%. Right. Whereas B will give the pounds to swap bank and they will receive 12%. So what eventually ends up is the net payment will be A paying swap bank in pounds and B is paying swap bank in dollars interest, right? Now this is a little risky. Well, the risk actually is exchange rate risk is also there for swap bank, right? So what they receive in one currency should be matched against what they receive in the other currency. Actually, their receipt should be more than what they pay, otherwise they'll make losses. Then the risks of swaps, interest rate risks, if interest rates change, right? The risk of interest rates going against you. Interest rates might move against a swap bank after it has only gotten half of a swap on the books, or if it has an unhedged position. Basis risk, if the floating rates of the two counterparties are not pegged to the same index. Exchange rate risk, in the example of a currency swap given earlier, the swap bank would be worse off if the pound appreciates. Credit risk is the major risk factor faced by swap dealers, the risk that a counterpart will default, right? So all of these risks, interest rate risk, basis risk, exchange rate risk, and credit risk. Okay, so these are the basic risks that we all know. Mismatch risk, if you can't match it perfectly, right? So for example, if you have to pay monthly dollar interest and quarterly sterling interest, then it's not a perfect hedge. You'll carry basis risk. Sovereign risk is the risk of a country defaulting. Country default is called sovereign risk. Right. So that is about it in terms of coverage. Do you all have any questions? Which you have to clarify. So I assure you once again that the exam questions will be simple. Yeah.
So can we have your
Yes,
contact line?
Oh yeah. Okay. Do you have any questions? If there are no questions, we can wind up. So I hope this session was useful. Try to add some value to your customers, right? There is plenty of benefits of using derivatives, and it's very important that you're aware of what you're dealing with, right? Right, so that's about it. Okay, so thank you very much. All the best.